Well, stocks rallied to fresh record highs last week, while the dollar also continued its recent rebound despite President Trump's apparent attempts to fire Fed Chair Powell, and of course, another deluge of tariff headlines in the mix as well. Looking ahead to this week, the data docket is, to be frank, a little bit barren and a little bit boring. The ECB, they're set to stand pat at their final policy decision before the summer break on Thursday. But besides that, there's little else for traders to get their teeth into, with focus set to remain on progress or lack thereof towards trade deals as the 1st of August tariff deadline looms large. In any case, plenty for us to discuss on the trade-off this week. So without further ado, let's crack on with the show. So a bit of a rollercoaster ride for markets last week, but hopefully calmer conditions prevail this week and we can all take a bit of a pause for breath. One of the big drivers of that, the political instability in Washington, D.C. Trump, will he, won't he fire Jay Powell? One person who won't be getting fired is my good friend Ryan Littlestone from Forex Live and Forex Analytics, who appears to have bought a book with him.
Oh, sorry, mate. I'm just looking at
Oh, Christ. Oh, God. I better warm up my Amex for Friday.
Yeah, I'll get another one. Yeah, I'm just looking at the 10 most expensive restaurants in Bournemouth for our little lunch on Friday. Yeah, sorry. I didn't mean to be so rude as to.
Well, we're not going to all 10. I can assure you of that.
Yeah, I know 2 of them.
Anyway, how are you, mate?
Yeah, all good, all good. Looking forward to this week. Yeah, you're a bit quiet on the data front, as you say, but no doubt the orange one's going to keep us busy long enough.
Yeah, of course. I mean, we may as well get into that, actually, because I want to talk about what happened last Wednesday. Right, let's crack on with the show. Rather a hectic few hours last Wednesday. Sat here sort of mid-afternoon here in the city of London, and reports started to emerge somewhat out of the blue that President Trump was seriously considering and preparing firing Jerome Powell as Fed chair. Apparently, he'd been asking Republican lawmakers for their views on the matter, and unsurprisingly, they all thought it would be a good idea if he did fire Jay Powell. And apparently, he'd even been running around with a letter, waving it around, that was apparently drafted to Powell, telling him that he'd been sacked. And that wasn't just reporting that came sort of via the usual unnamed sources. It was actually confirmed by White House officials. So it was very much an official message coming from the Trump administration that for a few hours at least, it looked like Powell could be sort of clinging on to his job. Of course, mere hours later, Trump then sat down in the White House and was speaking and said, no, those plans never happened. Not going to fire him. Got no plans to fire him. He's staying in his job and he'll be here until next May. So what the hell was that all about? I mean, it's a little bit peculiar, to say the least. I think, and my sort of gut feeling as the dust has settled on all of this, is it was essentially a trial balloon from President Trump saying, you know, what would the markets do if I were to try and fire Jay Powell? And if that reaction was adverse, then I'll just, row back on it. And if it isn't adverse, then maybe we'll follow through on those threats. But in terms of the market reaction, it was a pretty significant one, a big steepening of the Treasury curve around the 10-year yield, a fairly chunky move lower in the dollar, and also some selling in the equity market as well, which is very much as you would expect, though I would sort of multiply those moves by a factor of about 10 if the unlikely event were to pass that Powell were to leave his job. Now, of course, that is not to say, despite Powell clinging on, it is not to say that Trump is particularly happy with what the Fed chair is doing. We are still getting almost daily calls for the Fed funds rate to be lowered. I think last week Trump was saying that the Fed funds rate should be as low as 1%. So we're not far off that call for negative rates that we've been sort of semi-joking about for some time now. And I think this comes back to the point we were making last week, in that basically he's looking at interest rates through the lens of a real estate developer. The strongest, the best, the biggest, the tallest, the newest buildings, they offer the lowest cost of credit. And Trump thinks that the economy works the same way, but that is clearly not true. Although it must be said that underneath the surface of all the uncertainty that we're seeing, there is no data that justifies a rate cut in the United States, let alone 400 odd basis points worth of rate cuts that President Trump seems to want. Last week, we had the latest CPI and core CPI figures, both of those rising on an annual basis, their highest level since February. We also had retail sales, housing starts, building permits, initial jobless claims, and consumer sentiment from the University of Michigan, all beating consensus expectations. And on top of that, the labour market is still pretty resilient, as we saw with that jobs report at the start of the month, and inflation is likely to continue heading higher in the months ahead. We've only seen the first signs of those tariff-induced price pressures coming into the data. Now, what do we have? Of course, we are about 10 days out now from the next FOMC meeting. We've got Governor Waller running around screaming from the rooftops to anyone who'll listen that a July cut is necessary. Frankly, that's just a bit of a shameless pitch for the top job. I think everyone else on the FOMC, besides perhaps Governor Bowman, another Trump appointee, is very happy to just wait and see what happens, as they should. But it must be said that Trump's attacks on the Fed don't seem likely to stop anytime soon. The number one quality he is looking for in the next Fed chair next May is basically a yes man, someone who puts loyalty to Trump above everything else. And as a result of that, that continued erosion of independent monetary policy, in my view, leads only one way for the dollar, and that is lower.
Yeah, and something was interesting with those Waller comments because he seemed to do a bit of rowing back. In fact, he's been so adamant that they should cut in July, but when asked will he dissent at the next meeting, said he's not going to give an answer to that. He's not going to commit to dissenting at the July meeting. So is he going to put his money where his mouth is or not? And then after that, he even went so far as to say, it's probably not a problem if the Fed do stay on hold for a few more weeks. So what is he trying to do? I think maybe he's seen some of this better data last week, and he's thinking, maybe I'm going too far, too dovish to try and get this job. And if the data's going against me, then I'm not going to get it. So, yeah, definitely a bit of rowing back there. And it just, as we said a few weeks ago, it's making the Fed all the more political at the moment, with all these Fed heads coming out and making their cases and whatever. But yeah, as far as the Trump thing goes, this firing, will it, won't it? To me, it's like an option trade, really. It's going to suffer from time decay. The closer we get to that sort of September, October period where Trump is probably going to announce who his Fed pick's going to be, the market reaction is going to be less and less the closer we get to Powell ending his actual term. So, yeah, we've got a good indication of what the market wants to do on that. So we know what the effect's going to be. Will it be as big if it actually happens?
Yeah, I think that's a very, very good way to liken that, actually. And, we are not too far, really, from the next Fed chair being named. You would imagine probably 8-10 weeks at absolute most. The Waller one is interesting, and I know we had this discussion in your chat room last week. Waller's case around the need for a July cut seems to centre on this idea that the labour market is basically just frozen at this point. Hiring has slowed, clearly, but the pace of firing hasn't picked up. Now, in a sort of normal economy and in ordinary times, that would be a perfectly just and valid argument to lower overnight interest rates. The problem is the reason why the labour market has entered this sort of stasis is not because the cost of credit is too high. It's because there is so much uncertainty in the issue of trade on the horizon that companies have basically gone, we're not going to hire anyone. We're not going to fire anyone. We're just going to batten down the hatches and try and weather this uncertainty for the next 6, 9, 12 months. And when that degree of uncertainty lifts, we either go back to the plans we had 12 months ago and reassess, or we come up with a new plan. The problem is you could probably, it's a bit crude, but you could probably lower the Fed funds rate by 100 basis points or so. It's not going to have that much of an invigorating effect on the labour market if the degree of uncertainty on the trade front remains where it is at the moment. Businesses are not suddenly going to start hiring in their droves because money's a little bit cheaper if there's still all of this uncertainty around trade and what tariffs they're going to be paying tomorrow, let alone in 6 months' time. So I think Waller's argument sort of falls down quite substantially there.
Well, all their arguments fall down substantially, really, because, and we spoke about this as well, not a lot of people are looking at what happens should tariffs not have a big impact, should all these trade deals go through, and all these companies who are, they've pulled the handbrake just to say we want to know what's going on. If the situation isn't too bad, if they're not going to be affected too much, then they're going to start hiring again, and we're going to see wages going up, and we're going to see a boost to the economy, albeit maybe a bit of a relief rally. And so we could see higher inflation coming, that's not on the back of tariffs, but on the back of the economy picking up for 3-6 months ahead. And then what are they going to do with policy? Are they going to look through that and say, well, we're going to continue cutting rates now because we want to get rates down, which is still their end game? So it's, there's never a straight line to when they're going to start cutting rates again. And all the while, there are factors that could keep them from doing so for a while longer, even after the tariff mess finishes.
Yeah, absolutely. Plenty of moving parts. And that's before you even get into the whole dilemma of, you're potentially going to have a chair suggesting one thing at the Fed and the rest of the board and the regional presidents wanting to do something completely different. But we could do a whole show on that, I would imagine. Let's move on to something just as complicated, frankly, which is Japanese politics.
Yeah, I don't know where to start with this one.
Well, you chose it, mate, so it's all on you.
Yeah, cheers. One of those things I wish I hadn't started now. But no, the weekend elections went disastrously for PM Ishiba and has injected more worries for yen traders. Japan's political scene hasn't been solid since the prior election in the lower house, and now things are even worse because he's now lost the upper house. And all that comes amid the stalling trade negotiations with the US, which should have been a bit of a slam dunk for an early deal, given that the relationship between the US and Japan previously and how Japan has really been bending over backwards to show they're willing to invest more and buy more from the US. However, it doesn't look like Ishiba will have anything close to that sort of relationship that Abe had with Trump. And then we have the Bank of Japan trying to hike rates, and yet while their inflation has been running over 3% for some time, it's not the right inflation, as it's cost-pushing inflation, as they like to call it, temporary inflation. And a big part of that is down to high rice prices due to poor harvests. Now, the economy isn't doing too badly, but whether that can be maintained through all this upheaval is another matter, which brings us right around to the yen. There's quite a bit of divergence still between the crosses euro yen and dollar yen, which euro ends up near multi-year highs, while dollar yen is still caught between what's happening in the US and Japan. Now, dollar yen has rallied, over 600 pips this month, and I see the case for even further gains if the US economy stays steady and if Japan stays in this political mess for quite some time, and if we see some of that cost push inflation dissipate. Now, 150 may be a bit of a formality in the days ahead, but I can envision a rally back up to, maybe up to the year's highs, 159. So it's really going to need a big change in either the US or Japanese outlooks, or both, to get this moving meaningfully lower. Right now, we're seeing dollar yen actually coming down on the back of US yields, but the reasons why yen's been weak for so long haven't gone away, and this election is going to make it worse, I think.
Yeah, absolutely. I mean, this is a really interesting one. I was reading about this earlier on. I think it's the first time since the 1950s, so just when you started in the city, that the LDP have not got a majority in either the upper or the lower house in Japan. So I mean, this we shouldn't understate how significant the election result is and how significant a shift we're seeing take place here. But at the same time, the result, yes, is pretty shambolic for PM Ishiba, but it's not as bad as it could have been. Because I think a lot of the opinion polling was pointing to them getting, sort of mid-high 30s in terms of the number of seats before the election. They actually ended up with 47. So they haven't got a majority, but things are a lot closer than they perhaps otherwise could have been. And I think that's why we've seen the yen gain a little bit of ground to start the week, probably just to sort of sell the rumour by the fact, a few hedges being unwound that were put on towards the start of last week. Effectively, it's still pretty ropey, but the worst case scenario appears to have been avoided for the time being. The problem, as you rightly allude to, is there's now just even more uncertainty in the outlook. We don't really know what's going on with the US-Japan trade deal. Besant was in Japan last weekend, towards the back end of last week. Apparently didn't even talk about tariffs. Well, what was the point of you going? We've now got a government that's going to have to lean into making more concessions, even more concessions to opposition parties. We've obviously got the BOJ who are going to kind of sit there on the sidelines and go, well, there was already trade uncertainty. We've now got political uncertainty. We really don't want to deliver any hikes before we absolutely have to. So I think I agree with you on that bearish yen view. I'd be keen to see how we react around that 145.50-ish region. I think that's where the 100-day moving average comes in dollar yen at the moment, or at least it was where I left the desk earlier. But the big thing that I've taken away from this election result is the rally that we've seen in fixed income today. Obviously, JGBs, we're recording this on Monday for those of you watching. JGBs are closed. Japanese holiday today, another one. They have more holidays than Kyriakos, I think. But we've seen gilts rally quite strongly. We've seen bunds rally pretty strongly. We've seen the long end of the Treasury curve come 5 or 6 basis points lower as well. So again, that points to the market. Well, I think that just shows how jittery markets are over the fiscal situation, because if you did have a significant defeat for the LDP, that probably increases the chance of significant fiscal stimulus. And now they have lessened somewhat. So yeah, bad news for the yen, but potentially good news for the long end globally.
Yeah, very much so. I mean, it has been a bit of a strange move this morning. And as you say, with Japanese markets shut, we haven't got a full appraisal of what the Japanese think about it. So that's something, well, by the time you watch this, they'll be open again. So we need to see what happens tomorrow morning.
Yeah, absolutely. And if markets are in a completely different place tomorrow morning, just ignore the last 5 minutes of the show, please. Don't rewind it. Let's move on to here in the UK, the nice cheerful segment of the trade-off that we seem to have to cover every week. It was a busy week of data here in Blighty last week, and all of it was pretty ugly, to be completely honest with you. Let's start with inflation. Things are decidedly moving in the very wrong direction here in the UK right now. Headline CPI rose to 3.6% on an annual basis in June. That is well above the 3.4% that the Bank of England had been forecasting. It is also the fastest rate of inflation since the start of 2024. So we thought that the month of April was going to bring all the misery with the index-linked prices, and that was going to be the peak. Well, clearly it wasn't. More worrying than that, though, is signs that underlying inflation is also remaining pretty intense. Core CPI, that came in at 3.7%, up from a prior 3.5%. Services CPI, that came in at 4.7%, up from a prior 4.5%. So inflation high, and more problematically than that, moving in the wrong direction. At the same time, the labour market is getting quite dicey, continuing to weaken very, very rapidly indeed. Unemployment rose to 4.7% in the 3 months to May, above expectations and to a 4-year high. Earnings growth continuing to cool, unsurprisingly, as we see a greater margin of slack open up in the labour market. Pay growth running at about 5% year on year now, but public sector pay growth for the second straight month exceeding pay growth in the private sector. Maybe we should all go on strike to rectify that issue. More timely than that, though, is of course the HMRC payrolls indicator. That in June fell by 41,000, which is the 8th straight monthly decline in payroll employment here in the UK. What happened 8 months ago? The budget, where Rachel Reeves raised national insurance contributions for employers. Funnily enough, if you raise the cost of employment, firms either employ fewer people because they can't afford them, or they increase prices because it now costs them more to have those employees that they need. I wouldn't have said that that's rocket science, but clearly to the folk down at HM Treasury, it was something they didn't see coming. Sadly, the misery doesn't stop there. We've got borrowing stats due this week, which are probably going to paint a pretty grim picture once more. We do have retail sales due on Friday, though. They should show quite a decent rebound from May, set to rise by about 1.2%. But you've got to consider that retail sales fell by almost 3% in May. So that is more of a mechanically driven rebound than anything else. And against all of that, of course, every single data miss that we get here in the UK makes tax hikes in the autumn just a little bit more likely. So all of that bad news is going to be compounded in about 3 months when Rachel Reeves stands up at the dispatch box in the Commons. So is it really any surprise, Ryan, that cable has now notched 3 straight weekly declines. I mean, I feel like I'm at the point now where we've just got to say, we're the last sterling bull to leave. Just remember to turn out the lights.
Can't afford to put lights on at the moment. The way,
yeah, it's getting that way, isn't it, actually?
I'd blow out the candle, I think is the right term for that. But yeah, I mean, inflation, my mantra with UK inflation is always more stickier than it is elsewhere. It's always a struggle for the Bank of England. I'm yet to see any Bank of England governor or MPC board combat inflation significantly. And that is going to get worse because we've got further public sector wage hikes coming, I think, in August as well. So that's going to be another uplift to wages there. The jobs market, we 4-year high, but we're still at quite low levels overall in terms of the jobs market. So it's not a huge danger at the moment, but the trend is going the wrong way quite clearly, as you say, in 8 months of those job losses. So it's not looking good, not looking like it's going to get any better. As for the pound, I mean, cable's a different kettle of fish with everything going on with the US side of things. So I'm more inclined to look at euro sterling, and that's still looking very, very bullish. A lot to do with the pound weakness, just as much as euro strength. So that would be the ball I'd like to kick around if I'm trading it.
Yeah, I think that's a good point, actually. Cable is very skewed by the nonsense coming out of Washington, D.C. at the moment. What are your thoughts on the BOE? Do they still cut in August? I'm still very much in favour of an August cut, but then the dovish pivot that I was thinking they'd make is probably certainly off the cards now.
Yeah, I don't know what they do. I mean, they could have cut.
They know what they do, actually.
No, exactly. I don't know what they're going to do, and that's still more than what they know. Yeah, we said last week or the week before, excuse me, that they could have cut 25 pips at the last meeting. It wouldn't have affected anything. It would have just given maybe the economy a little bit of easing to take into the summer. Before that data, the CPI data, you would have said, they would have been nailed on for a cut. But they've continued to be between this rock and hard place. We've got inflation going up, jobs coming down. What do they act on, inflation or the jobs market?
Well, their mandate's inflation, so I would argue that's what their focus should be on. Whether that is where they decide to focus or not remains to be seen. Yeah, absolutely. We'll probably end up with another 3-way split on the MPC or some nonsense. Anyway, we can discuss that in a few weeks. You want to talk about possibly the most boring ECB meeting that anyone could think of.
Yes. And I'm not picking this topic because it's probably the least analysis I'll have to do, as we are pretty certain to be getting no rate move at this meeting. And Lagarde will no doubt have a taxi waiting outside ECB HQ with the meter running, ready to whisk herself off to the airport for her holidays. But it's still important to pay attention to see what they might indicate for the rest of the year. Firstly, on the possible rate move, it's not likely until September. However, we do have excuse me, we do have the annual Fed's Jackson Hole Symposium, August 21st to 23rd, which can often be used as...
Your invite arrived yet?
As what, sorry?
Has your invite to Jackson Hole arrived yet?
Oh, I turn it down every year. Yeah. They ask me every year, and I say no. Maybe one day I'll turn up just as I'm about to retire. But yeah, we do have the symposium. As I say, it can be used by some central banks just to drop little hints if something in the fundamentals have changed, particularly while they've all been asleep on their sun loungers. Now, the currency should enter discussions at the ECB meeting. And while a few ECB members, including Lagarde and de Guindos, have been giving the euro a bit of a green light to continue strengthening, there has been a slight pushback, particularly from de Guindos, clarifying that any further gains to 120 could prove tricky for the ECB. There are other mumblings out of the ECB that a fast move higher in the euro wouldn't be so welcome. So aside from that, the ongoing trade negotiations are still a weight of uncertainty for the ECB to deal with. But we also get Thursday flash PMIs ahead of the meeting, which might, excuse me, got a bit of a frog, which might give some added information to the ECB on whether they're seeing a pickup in the economy and all those hopes for defence infrastructure spend coming to fruition. Now, for euro dollar, the foot may be off the gas pedal a little for the summer, as we seem to have topped into the 118s, but The dip so far looks nothing more than a minor pullback. 115 is the key level below here, and a move under there may mean we're done with the highs for a while, but staying above there likely means that potentially 120 is still on the cards.
Yeah, I would agree with that. I think that's sort of, well, the prior highs are about 115.70ish, aren't they? And then you've got the 115 figure, which is obviously the psychological level to keep a close eye on. Agree with you. So as long as we're as long as we're above that, I think the bullish trend remains intact. What did the ECB do this week? I mean, absolutely nothing. There was a Reuters sources piece out probably a fortnight or so ago now, basically saying policymakers don't want to act on possibilities, they'd rather act on certainty. So they'll discuss the prospect of these 30% US tariffs, but they're going to wait and see what actually happens before making any further rate moves. So I mean, the other thing is, when has a European ever wanted to rock the boat with anything before they're going to go off on an 8-week long summer holiday? I do think, though, that the ECB, again, as they tend to be, have been a little bit foolish in terms of some of these comments around the currency, especially when you've got the vice president on TV channels going, oh, well, if we get above 120, it could get a little bit complicated. Well, why don't you just throw a target out there for the market to take the price to? Because that's how markets are going to work. You look at what happened with dollar yen over the last couple of years. All the time, people come out and say, we're worried about the speed of the move, or markets are getting a little bit too far ahead of themselves. What are markets going to do? They're going to test. They're going to try and find that pain threshold. So I think the ECB, in the longer run, may regret doing that. And actually, by extension, I think certainly the only reason I would see the ECB delivering another rate cut, besides a negative outcome on trade, is just to try and tamp down on the value of the euro a little bit if we do get up to around that 120 mark. Because, of course, remember, the ECB's June forecasts, they were conditioned on euro dollar at 114. And they still had inflation undershooting the 2% target quite considerably next year. So if you get up to 120 and stay there, by the time you get to the September forecast round, how much more of an undershoot are you looking at by that time, particularly if you've got things like lower energy prices in the mix as well. So certainly something to watch. But I don't think the ECB, well, is the ECB ever interesting? I was going to say it won't get interesting until mid-September, but maybe I'm being a bit kind even then.
Yeah, well, considering I'll probably spend most of Thursday talking about what she's wearing and whether De Guindos is going to speak, that pretty much sums it up. But you're right, and I've been saying it for a while, and I'll continue saying it. They've given the green light to the currency, and if that genie gets out the bottle, they will not be getting it back in again anytime soon.
No, and they also have no idea how they could even try and get it back in, which is perhaps half the battle with that one. Anyway, let's move on to our plays of the day. Right, to be honest, I could do with a genie to grant us some wishes that our plays of the day come true this week. What am I looking at? I'm looking at treasuries this week. Before anyone moans, I'm going to look at it on a yield basis just because I'm being lazy, but obviously translate it into price if you're going to trade it. We've been stuck in this kind of 4.75% to 5% range for quite a while now. We did have a little bit of a foray above it towards the back end of last week. And in fact, Tuesday, Wednesday, Thursday, we closed north of 5%. And that equals the longest run of closes above that 5% mark since all the way back before the financial crisis. But we couldn't make it a fourth on Friday. Dip buyers emerging and those gains extending a little bit as the new trading week gets underway, going back to what we were saying about a little bit of a sigh of relief after the Japanese election results over the weekend. What have we got on the horizon? Well, the event risk calendar is actually a little bit light, specifically in terms of treasury risk, until the FOMC next Wednesday. And frankly, even then, I struggle to see that being a particular surprise. So you're really looking to next Friday's tariff deadline and, of course, the July jobs report as the big risks on the horizon. So with the FOMC in the blackout period, the risk event docket pretty light, and apparently fiscal jitters on the back burner for the time being, not only out of Japan, but also as the dust settles on that one big, beautiful bill coming into law, it looks like dip buyers could flex their muscles a little bit here. It's certainly not something I'd look to get particularly greedy with. I think those yield tights that we saw, where is that on the chart? Towards the beginning of July, back into June, around 4.75%. That's probably as far as we'll go if we even get that far. But I do think that in the short term, at least, Treasury bulls may begin to reassert themselves at the long end of the curve. Ryan, you're looking at WTI.
Yeah, well, a little bit of a nod to one of our viewers asked, I think 2 weeks on the trot to look at oil. We failed to do on both, so I finally made sure that I made note of it and getting around to it. So my play of the day on oil, this one has one eye on the PMIs later this week and whether the good news that we've seen in manufacturing, particularly in the US, is going to continue. The oil market needs a bit of a spark, I think, from the fundamentals. And if not today, any future signs, as I said, that tariffs are not going to be a big burden to US firms could unlock some of that hand sitting and bring a decent boost to commodities across the board. So for this week, I'm favouring buying a dip in WTI down to the bottom of my zone around the 66 mark. I've got a zone 66 to 67 bucks, maybe even down to the 65.20 support. For a little bit of a run into the PMIs.
Very good. Well, I say very good. I'd actually take the opposite view. I think crude is probably going to continue barreling lower with fundamentally dealing with the market. Sorry.
Where is it?
What are you rummaging around? Oh, there we go. God. Well, your yellow one doesn't work, so I have to go straight to a red now, don't I? That's the problem.
Yeah. Listen, you can't take. Listen, you haven't even settled your last bet before you start making other bets.
No, we're not going to have a bet on this one. Don't worry. I'm just saying, fundamentally, we're dealing with a market that is massively oversupplied. So I think any rallies are there to be sold into. But anyway, we can discuss that another time. That does bring us to the end of another show. Thank you very much, as always, to my good friend Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me. Thank you to our producer, Kyriakos, as well, for bringing things together as brilliantly as always. Do hope you've enjoyed the show. If you have, please do drop a like on the video. Leave a comment as well if there's anything you'd like us to discuss next week, or any of your thoughts or burning questions on the markets. We will do our best to get back to you, and we will be back with another episode of The Trade-Off this time next week. In the meantime, have a very good week ahead, and we'll see you then. Thanks as always for watching. Goodbye for now.